Morning, everybody. I hope you had a good night's sleep. Welcome to the second day of the workshop. Today, we will start with Ms. Yan Ling. She's a senior infrastructure investment and financing consultant. So she has 20 years of experience in cross-border financing, mergers and acquisitions, and an investment advisory primarily serving Chinese and Asian investors in sectors such as traditional and renewable energy grid infrastructure and transportation development. So, see you.
Thank you very much for the introduction. Hello, everyone. Good morning. My name is Aileen Yan. Very glad to be here and to have this opportunity to go through this topic of infrastructure investment and financing with you. So today, we have 4 sections for today's discussions. The first we're talking about is covering investment and financing of PPP projects. We will see why we focus on infrastructure projects instead of other type of infrastructure projects. And then we will look into the project finance aspect because the debt financing is actually at the center of all the infrastructure projects investments, especially for greenfield projects. And then at the last, we look at M&A transactions in the infrastructure sector, covering the process and execution procedures and all the things that need to be done in those 2 infrastructure acquisition transactions. And at the end, we will have a Q&A sections with everyone here. So with that, we'll go to our first part about the infrastructure investment and financing of PPP projects. So there are a broad range of infrastructure projects. So infrastructure projects can be classified in 4 categories in terms of ownership structure. So at the two ends, majority of the infrastructure projects in many countries are actually government owned. So which means the infrastructure projects are either owned, operated directly by government authorities or by the companies, entities set up and controlled by the company. So in China, for example, and also actually in Singapore, Malaysia, even in Indonesia, a lot of majority of the critical infrastructures are government owned. So this is one side. On the other end, there are privately owned infrastructure projects, which means the projects are completely developed, financed, owned, operated by the private sectors with a minimum government involvement. And the private sectors are only subject to licensing and the regulatory requirements under the legal and regulatory systems in the country. So this type of projects will cover a lot of really projects, infrastructure projects with real estate elements. For example, data centers, industrial parks developed by the private developers, or social infrastructures, private hospitals, private schools, international schools, and also, for example, in some of the countries where they have liberalized or privatized a lot of the infrastructure projects. For example, before 2000, Singapore government actually privatized most of the power generation facilities. So those power generation power plants in Singapore, they're all owned by the IPP power plants, including a lot of international investors from Singapore, from China, and also the Singapore investors as well. So between these two, there are two groups of projects. The larger group, and which is becoming increasingly popular, is the PPP projects, public-private partnership projects. So PPP or public-private partnership, it is called operative contractual arrangements between the public and private entities. And the purpose is actually to attract and leverage private sector capital and expertise to design, develop, finance, build, and operate the projects. These type of PPP projects are usually covered. They are on a contractual basis, which means there will be a concession agreement. Sometimes it's called a service agreement, or is a lease agreement between the government and the private sector investors. There will be, under this agreement, there will be concession period of around between 20 to 30 years. So the government still plays a very significant role in this type of projects, because the government, on the one hand, it regulates how the projects, the performance requirements for the project, the timelines, the responsibilities, obligations of the private sectors, and it also outlines the government's obligations. For example, the government support obligations, the offtake obligations of the governments, and the support by the government to provide or renew the licenses needs and providing support in the land acquisitions, etc. So the PPP is actually that is very much structured and contractual based type of the legal structure of the PPP projects. In Southeast Asia and also in China, PPP has become popular ways to initiate the infrastructure projects since around 15 years ago, around 2010 to 2015. So that was, especially in China, there was a very high growth of PPP projects. at the provincial level and also at the municipal level, covering lots of projects. In Southeast Asia, we can see that including Malaysia, Indonesia, and Thailand, a lot of governments before COVID-19, the governments actually launched in this region, launched quite a PDP programs for some very important national strategic projects. For example, in Thailand, there's East Economic Corridor projects, EEC projects, which are all including the airport, the ports, and the railways. Those are all structured as PPP projects to invite private sectors to bid for the projects and the finance and construct those projects. In Malaysia, for example, what I can see is in the power sector, especially in the renewable energy projects, they have been using these forms of public tenders, although the large scale solar program, LSS program, the Malaysian government has launched I think 4 or 5 LSS programs so far. In Singapore, the PPP projects is used not so often. That was because in Singapore, first of all, infrastructure is relatively well developed. And the second reason is because in Singapore, the Singapore government has a very high sovereign country rating of AAA. So that exceeds the credit ratings of all the private sector investors. The Singapore government, their funding cost is much lower than the private sector investors. And also the governments have experience operating some of the critical infrastructures, for example, the water treatment plants, and also the power transmission and distribution sectors as well. So in Singapore, we don't see that many PPP projects as in other parts of Southeast Asia. And then after PPP project, there's also another type of projects which are privately owned. They are subject to the government's strict regulations. So these are called the regulated operations. So these tend to be the gas and power distribution and transmission distribution services. Because, like for example, like in Singapore, this is the power transmission is controlled by Singapore Power Group, and in Malaysia, the power transmission and distribution is controlled by Tenaga. So these are Tenaga is a separate government-owned business, so we can actually see this as a government-owned projects. But in some parts of the world, for example, in European countries, some of these distribution, energy transmission distribution businesses, they are operated by private sectors who bid for the licenses. But then these private sectors, they don't have the liberties to decide the prices of their operations. Their revenue and their investment returns from this type of projects are kept by the fee rates agreed approved by the government under each regulatory period. So each regulatory period can be from 3 to 5 years, and afterwards the government will review the cost of capital or the WACC for this particular assets, and then which will decide on the return and the revenues of this business for the upcoming regulatory period. So these are the regulated assets which are privately owned and operated and subject to very strict government regulations. For like other sector investors, including a lot of engineering, construction companies, and operating multi companies, and also financial institutions of private equity funds, infrastructure funds. The focus of these private sector players is actually on PPP projects. This is where the check and investors that they can really they can very take very active roles and substantially other responsibilities from construction, financing, operation to the end of the concession period, which typically covers the majority of the project life. So that's why for this, we focus on discussing the PPP projects in this sector. So next one for PPP projects, there are different types of within the PPP projects. There are different a few categories. So very often we will see we call it BOT, build, operate, transfer, design, and design, build, and operate, BBFO, and BOO structures. So all these type of the name of a BOT, PBFO or BOO refers to actually the differences in the ownership of the projects and some of their revenue generation models, as well as the reflect some of the differences in their durations. Example for BOT projects, it emphasizes the private sector's responsibilities to build, operate, and transfer. So the transfer means the ownership of the projects will have to be transferred back to the government, hand over to the government at the end of the concession period. For DBFO projects, this emphasizes the design, because in the BOT projects, actually, the design can be already defined by or specified by the government already. So this applies to a lot of the power plant or very typical mature infrastructure projects where the government will set the scale, the capacity, the type of the technology used, versus in DPFO type of projects. The private sectors also need to take responsibility for design of the projects, which means they can provide more innovative solutions using different type of technologies, using different scales and not to the one the same skills. They can adopt by proposal design with the capacity that's most cost efficient from the private sector's perspective. For BOO projects, I think the only difference between BOO and BOT is the last water transfer or not transfer. So BOO projects are projects that will be usually owned by the private sector, so it will not be transferred at the end of the 25 years or 30 years, but it will continue to be owned by the private sector investors throughout the entire project life. So, despite of the differences in their ownership structure and in the ownership or duration of the ownership, as well as the slight differences in the responsibilities, all these three type of projects, they can be, they are investable and they are acceptable. They can attract, all of them can attract, are able to attract private capital, despite all these tiny differences in ownership. So that means ownership is actually not a key for the bankability of the projects. In terms of the revenue models, there are some slight differences in the revenue generation models. For BOT projects, is very usually the fee is generated from users or is collected from users directly. For example, toll roads. This is the typical BOT type of structure. for DBFO projects, very often the revenue is dependent on the annuity or availability payment from the government. So, for example, in some of the waste treatment plants or water treatment plants, they can be purely the operators or the project companies actually don't sell their outputs or products to the end users directly, but the government will pay availability payment, capacity payments as the revenue to compensate for the investment cost of the private sector investors. The POO projects, the revenue could be either, and for the DBFO projects, it could also generate part of the revenues from actually the sale of the products. For example, the electricity sales price, etc., renewable energy project. And for the POO projects, it is often the revenues generated from the sale of the sale of the outputs of the project. And then coming to the key characteristic of PPP projects, we focus on emphasize that these are contractually based, so which means the projects, especially for greenfield projects, all the financing is actually dependent on the documents, project agreements, and as well as the financing agreements. But the financing agreements they are also based on the project documents. The key project documents is this is the PPP agreement between the government and the investor. And then they also include other agreements such as EPC contract, own operation and maintenance contract, service contract, etc. So these are contracts with third parties. So checks in case, because the check is an engineering construction company is poor EPC capacity. So if the check step in as an investor, actually it is looking for a role both as an EPC contractor and also as an investor. This is not unique because a lot of the Asian large engineering companies actually operate to take this investment model, and including Japanese and Korean companies. They have both the investment business as well as the EPC contracts, and the projects they invest tends to be the projects that use them as the EPC contractors. So this is acceptable to the financial institutions who provide the financing as long as the EPC contractor or the shareholder has the capacity and experience in building this same type of projects. Although, like most of the process to appoint the contracts, including EPC contractors, will have to be subject to competitive tender process acceptable by the lenders to ensure the transparencies and the EPC cost is the most cost efficient through the competition. For the PPP projects, the private sectors will assume substantially all the financial, technical, and operational risk, and the reward for the investors are actually have to be recovered from the revenues generated during the concession period. So, and why PPP projects? Actually, as we just discussed, that in the level of PPP projects, or just the penetration of PPP projects in infrastructure sectors are not the same. for all the countries. So it really depends on countries, their national and regional development initiatives, the government's the country's infrastructure needs, the government's budgets, the government's own financing capabilities, the legal systems and regulatory systems. Because for the type of the project, PPP projects, because it's all really contract based. So the regulatory and the legal systems are very important. It's not just the legal aspect, but it's actually directly affect the financeability of the projects. So in some of the countries where there's no the acts or the laws, the it's becoming very difficult actually for investors and investors to step in because there's no clear mechanisms to support the investors to enforce and recover the assets if there's something goes wrong. And also, it also depends on the private sectors, of course, the macroeconomic environment, which decides on whether the markets of the projects are attractive to the commercial viability of the projects. The investors, private sector investors, are only attracted to projects that are commercially viable, which they believe will provide predictable, stable revenues and returns to them. However, from the public sector, government's perspective, they also need to consider about the public interest, the social needs. So they are projects which are not commercially viable, but they actually have the public that have to be developed because of the needs of the public. So this type of projects are not actually in the PPP, will not be launched using the PPP type of structure. We talk about the PPP project. PPP project can be applied to broader variety of infrastructure subsectors in transportation and logistics. In transportation and logistics, for example, toll roads, for example, I think in Malaysia and in Singapore, toll roads are operated by the government's own entity operators. But in Indonesia, a lot of the toll roads are actually PPP projects, and the same in China as well, in India as well. So all those are PPP projects. And also the railways or subways, the light rail, urban rail systems, they can use adopted PPP structure as well. However, for the railway projects, because the investment cost is so high and the project is so complex that it composes different assets components. Sometimes the railway projects, subway projects, they can be actually structured as multiple projects which comes together to provide the services. For example, the railway projects can have either one asset company or three asset companies. So asset companies will be the rail infrastructure assets, the signaling telecommunication systems, the trains assets, and the train stations. So the assets companies can actually be separated and structured as a single project. And also there is operation and maintenance passenger services companies. So in a lot of the countries where the railway, because the infrastructure investment in the railway is so high that actually the private sector is not able to actually pay all the to meet all the financing needs. So sometimes the governments will actually separate out the infrastructure parts of the assets. So the assets companies will be owned, especially the rail infrastructure or the signaling of infrastructure, they will be owned by the government. However, government would use the PPP structure to attract private sector operators to operate the train stations, and also to maintain the train fleets. So the transportation logistics companies, it is widely used. Another example, I think, is the airports as well, especially airports in Philippines. They're mostly using the PPP, but it is actually the services part, which is the PPP on the PPP concession agreements. Also, the other very big categories are energy and utilities. So energy, including the power generations, which are power generation, renewable energy, including solar power, and gas power plants, coal power plants. Of course, now there are more and more the renewable energy projects, waste to energy projects, waste management, water treatment, desalination, water plants, etc. So these are very big sectors for the energy and utilities that are using this PPP structure. Telecommunications as well. For example, telco towers in the Philippines, they are under PPP structures. In some countries, the satellite services are also structured as a PPP structure under lease agreement of the telecom operators and the governments. And also, I think increasingly more social infrastructures, especially for the hospitals, especially after COVID. So the governments wants to develop, build a hospital projects. They also invite private sector operators to join with the construction companies to using the PPP structure to roll out the new hospitals. So these are the four main categories of the infrastructure projects that are suitable for PPP. And we discuss a little bit about the structure and also the key players in PPP projects. So the key players, as we discussed, are already covered. They are government entities, which is usually contract authority. The agreement is called for the contract authority, and the private sector investors are usually referred to as sponsors or shareholders. Private sector depends on the size and the investment requirements and complexity of the projects. Very often, private sector, there are multiple private sector parties involved in one project and they form a consortium. So the consortium could be 2 or 3 consortium members in one project. The purpose is because very often you will have one sponsor who has the construction engineering expertise, and another local companies will be required to join who has the operational experience as well as the local market knowledge, and also private equities are very active in PPP projects. Private equities are usually provide equity. They complement the equity contribution requirements of the strategic investors may not be able to provide by themselves. On the right side is a very generic the contractual structure of a PPP project. So in the PPP project, the other key players in the PPP are the financial institutions, which are the banks going to finance, provide majority of the funding requirements for projects, especially for greenfield projects. So the banks provide both financing as well as other financial instruments. For example, the bonds, performance bonds, standby LCs, and guarantees, financial guarantees required to make them to allow them to provide some guarantee and credit to the sponsors. The sponsors is responsible for the equity contribution portions. And later we will talk about the types of financing used to finance the PPP projects and all general infrastructure projects. For the PPP projects, because I think for Czech and also a lot of the projects actually greenfield projects, which means that they have the projects are greenfield and require private financing, funding, constructions. Some of the projects are brownfield projects in Southeast Asia or developing countries. Relatively, there are not so many operational operating assets as the projects. As the majority of the PPP projects actually haven't reached the end of their first concession period. So that's why we are focused on the financing for financing investment opportunities in developing countries in Southeast Asia, majority of greenfield projects. So because most of the countries actually have the PPP laws and also the public procurement laws. So if the projects majority of projects actually have to go through competitive tender or auction process. This is the same process. Every country have the government has a very established PPP tender process. A minority of the projects which are actually not subject to this tender process are the G2G projects. So for G2G projects, for example, I think the most is the Jakarta Bangkok high-speed rail projects, and also the China-Lao railway projects from Kunming to Vientiane. So these two railway projects actually G2G projects. They're not, if there's no public tendering, they are directly negotiated between entities appointed by the governments. However, largely most of the opportunities will come from public tenders. So this is why we will spend maybe a few slides to go through the public tender process. So in a typical public tender process, which may vary, there's some variations from country to country, subject to local legal requirements. But in general, it will have a preparation announcement, a preparation phase and announcement phase. So the governments will play a key role in this phase, identifying the projects. So this project identifications, usually is based on national strategic development programs or the infrastructure development programs. We will go through the project and have a long list of the projects, and then have the short list of some of the projects as the priority projects. And then there will be pre-feasibility studies performed by the governments, or usually it's commissioned by the governments. However, in some countries, the cost of this pre-feasibility studies is actually coming from the private sector investors, which means the of the projects. So, we can say actually the private sectors are not just lots of the private sector investors, especially for the local companies, they are very proactive in pursuing because they were being involved in feasibility study. But sometimes the investors can also participate just after the launch of the formal tender process as well. And the pre-feasibility study will provide some front-end conceptual designs specify the technical requirements, and in some of those projects, they would decide on the design of the project. And the government will then launch a tender process. So typically, you will have the financial advisors to run the formal tender process. The projects, which is they will issue the request for proposals, some IFC. Sometimes before they launch the formal IFC process, for the larger projects, the government will also run market engagement or market sounding process to assess the private sector's interest in the projects, and they would they could also set either a pre-qualification or express of an interest phase before formally inviting or allowing the private sector investors to join. And then for the tender documents, for the phase one, the government project identification feasibility study, the timeline is not very clear. For critical projects, that the government that's already on a high priority list, the government can have a shorter timeline. But some of the projects which are more difficult, which refers to a lot of projects that are not commercially viable on a standalone basis. The projects that require actually some level of government revenue support, those are the projects actually will take much longer, because the government support portion have to be goes through the government's, also the parliament's approval, the regulatory approval process, and also the budgeted into the government's new budget as well. So for the projects that requires bilateral negotiations or additional government support, tax incentives, etc., these are actually the projects that is a very unpredictable timelines. It would be very difficult to actually materialize. And I think that's even though those are tend to be large scale projects, but actually it's very difficult to get into execution or even the tender process. For the smaller projects or energy projects or utilities projects that within the defined sites, water sector, etc. Especially for projects that actually rely on user speed, and it depends on the income. The revenue is actually generated from end users without the government support. This type of projects actually tends to be that can actually have a shorter preparation time, and it is most likely the government will mostly support and put it into the formal tender process. For the bidding submission and preparations, this is the critical part from the investors' point of view. Typically, the government will give about 3 to 6 months, and is a period for the bidders to prepare the proposals. The proposals would include 2 or 3 envelopes. So typically it's 2 envelopes. It was corporate documents, etc. So one is very important is the technical proposals part. The technical proposals part will include those technical solutions, as well as the demonstrations of the bidders' technical capabilities to build and operate a similar type of project. So the technical proposals would allow investors to actually bring in their contractors. And actually the contractors have to be identified in technical proposals of which EPC contractors and which O&M contractors. If none of the consortium members has operating experience, how is going to who's going to be the operators. And the government usually will also request the term sheets of the EPC contract and term sheets of the government agreements to be included in as part of the technical documents. And of course, the design, some of the in just rather than depending on feasibility studies, the bidders may actually also have to perform their own technical feasibility study as well. The very important part here is about the cost, CapEx cost estimations and construction scheduling arrangements. So these are all part of, and the designs, if it's the designs have to be if the private sector is responsible for the design of the project, so design of the projects have to be delivered in the technical proposals. The other part of the documents is the financial proposals. So the financial proposals include the first is the bidding price. So the bidding price, not all the projects requires a bidding price. So bidding price refers to the price that will be for the availability payment type of structure, which requires the government supports. The bidding price refers to the annuity of the fees that the support required from governments or the price that the government's off-take agreements have to be based on. For the users-based type of the structure like tolls, the bidding price can be the base price. The base year, the total or the base year the price. But sometimes the price is not, it's completely based on the users. Very important for this, during this process, the bidders of private sectors need to do actually the demand forecast. So this is applies to like all the projects or all projects. But it's not under availability payment type of structure, but it actually depends on the user's fee and demands. So the demand forecast will become very important. The bidders probably will not rely purely on government's demand forecasting and feasibility study. We really have to do the feasibility study. So this is part of the bidders' due diligence as a forecast as well. Very often include the forecast. And then included in the financial proposals, also there is the forecast. The third part is actually the financing, source of financing. In the financial proposals, the bidders need to articulate how the financing will be arranged, which banks have indicated that they are provided the support letter, have signed up the commitment letters. Most of the governments actually request or require the financial proposals to include the term sheets and commitment letters from the lenders, like of the bidders. But because at this stage, majority of the banks will not be involved very deeply, and they haven't conducted any due diligence process. They are not in a position to provide the commitment letters at this stage. So what they usually do is to provide a letter of interest, a letter of intent to support the bidders' bids. And we see that in this region because there are a limited number of the banks who are capable of providing long-term plans. So you will find that banks may actually support multiple different bidders in the tender process. So this is the evaluation and submission process. And then after submission, there is goes to the evaluation process. So the government's evaluation is because this is about the compliance issues. The compliance is a pass or fail type of review. So only the bidders who have passed the compliance requirements will go technical evaluation process. And after the technical evaluation process, there's a financial evaluation process. Some governments will actually have a sequential process, which means only the projects that pass the technical evaluations, and they will select a short list of bidders and then going to evaluate their financial evaluations. But more often is that government will actually review both the technical proposals and the financial proposals, and they will score or give a grade to each proposal, which is a graded score with different weights to the technical proposals versus the financial proposals. For projects that involves a very complex or sophisticated technologies are very much focused on the technical aspects, technical qualifications of the bidders. Government will higher weight on the technical proposal like up to half. But for projects actually that uses very mature technologies, pricing on a financial proposal is the most critical one. It can in renewable energy projects, for example, the price proposal for the financial proposal is probably only determining of the performance winners because the government most of the weight in the financial proposal. And then the government will come to, after the evaluation, come to the final selection process. The final selection process, government usually will have to select one winner, and then one standby or secondary winner as a backup to the winners. If the first one fail to come to terms, agree with the government in final terms. So after selection, after the government will make a public announcement of the winners, and then the winner and the government will enter into a period of exclusive negotiation phase. So during this negotiation phase, the focus is actually on the concession agreement project documents. And sometimes it also included the land disagreements if the land is provided by the government. The project documents, actually the draft of project documents, very often is already included in the request for proposals from governments already. And then usually in the tender documents, the government will request bidders to actually list out all the non-compliance or request for amendments. These are and all those the requested changes or amendments have to be reflected, included in their proposals before the government will accept any of these. For the actually as a bidding strategy, lots of the bidders will not actually put out very strong opinions about the market setting, like one particular terms versus another. So the other key terms that are subject to negotiations are first is a timeline of the milestones of the projects. The secondly is about the compensations, the government's compensations for early terminations, the default penalties, default penalties, and also the government's obligations, etc. So these are the key commercial terms that the sector investors are most actually focused on, and then with the request amendments to the from government perspective, they were trying to actually elevate, the responsibilities, which will come down later about the risk allocations, they would prefer the private sectors to share or to show them most of the risk that is associated with the project. However, for investors' perspective, to make the projects and to allow the investors to limit their own obligation to their own equity contributions, they have to negotiate and trying to put some of the risk back to the government. This will discuss later. So there's a negotiation process in which it is the winners lawyers actually will be engaged at this point to pursue the negotiations, and after the agreement is finalized, then it comes to a signing agreements. So along with this is very important is actually the debt financing process here which actually will start. So when the investors usually would approach their banks during the bidding process and asking for banks support, but only after they are shortlisted by the government will they bring their banks, and then we start this bank financing process, which next phase we'll talk about bank financing. So the banks will start their due diligence about the projects at this stage, and the signing of the PPP project is not a financial process. So usually the government would request the bidder, the winners to start construction, let's say within 6 months or after the PPP is signed. So which means the investors actually need to complete the debt financing documentation and signing of the financing agreements within this period to reach the government's milestones. If there's any breach of the milestones, actually is quite a severe penalties in the form of the performance bond or the fee bonds actually will be confiscated. The bonds will be drawn by the government. And then, so this is we talked about the financing arrangement and financial close. On the right-hand side, we also show a very indicative funding requirements and also the financing structure of the typical projects. So the funding requirements include the key part is actually the EPC cost, which is usually largest the capital expenditures of projects, which is the represents 70% or even higher of the requirements. There are also non-EPC costs. Non-EPC costs includes insurance, feasibility study, consulting fees, etc. So all these are non-EPC costs. There's also contingencies for the EPC cost. Contingencies typically are 5 to 10% of contingencies when investors build a financial model, they will include at least 5% of contingencies. And then there's a financing cost, including both the upfront financing cost and the interest during the construction period. So for the debt finance rates, all the interest, because the project is not generating any revenue, so all the interest expense incurred during the construction period have to be covered in the financing. And the financing coming from two parts, equity and debt. So for infrastructure projects, very few equity investors has the capital. And actually, if the project has to be financed, if they cannot raise sufficient high level of debt finance, we can say the project is almost not commercially viable, and the investors will not pursue. The investors shouldn't pursue this type of projects if the project is not able to raise finance transaction. The project finance typically they have to cover 70 to 80% of the total funding requirements. 75 is actually a ballpark numbers that the minimum target for lots of investors. In Singapore, because for some of the projects where the revenue is actually completely dependent on government's availability payments, the Singapore government's sovereign rating is so high. This type of project we have seen the gearing ratio can go up to over 80%, like even nearly 90%. But then it will not actually, for the Singapore investors, they wouldn't actually do this type of financing and all construction start. They actually do the refinancing after construction completion because at that time, the construction risk has disappeared. So the projects are de-risked, and then with the government off-takers, the projects can raise even higher debt gearing ratios. So the equity contribution is about 30% of the equities are required from the investors. So after the winning projects in tender, financing, debt financing is a very intense process, and actually is very critical because the constructions will not start until it reaches the stage of the financing agreements have been signed and all the conditions set up in these agreements have been met or satisfied by the sponsors. Then that's what we call a financial close, which means the debt loan agreements is able the sponsors, all the project companies are able to actually draw down, make the first drawdown on the loan financing agreements, which is called the financial close. The financial close is that actually typically it comes at the same time as the notice to proceed. VTP will come hand in hand with at the same time as the financial close. So it's an important milestone for our project. And here we talk about in setting up financial proposals or actually determining the bidding price. The most very important part of the work that needs to be done by the sponsors and their advisors during the bidding process is actually the risk assessment, risk allocation analysis, and also the financial modeling. So all these two parts have to come together for the purpose of financing structuring, as well as for the purpose of assessing the commercial viability and the feasibility of the projects. So here we're talking about the risk assessment and risk allocation is where the complexities that the public process, because the government already drafted the PPP documents. This is the case in Southeast Asia. Majority of the projects have a drafted PPP by the government, but then for G2G projects, actually the PPP documents actually can be drafted by the sponsoring government or the funding governments or the entities by the government to take lead in the projects. So the risk assessment and the risk allocations is to the principle of risk allocation is at the center of the bankability issues, of the bankability method of projects. So the risk allocation principles for project finance is that there are different types of risk which we'll cover later. The risk, each individual risk has to be allocated to the party which has the which is most capable of managing this risk or absorbing the losses from such risk. So that's why the risk items have to be identified and quantified. And then whether who is taking responsibility, who bears this risk, whether it's government, it's private investors, or it should it be the contractors, or should it be mitigated through insurance? Usually, investors will do an item by item risk analysis with their financial advisors, people investors. And then the other part is actually very critical part, the heavy lifting work is the financial modeling. So the financial modeling for PPP projects in the process, the government typically requires the models have to be follow the project finance best practice. So very often it's actually developed by professional consultants like me. I used to provided quite a lot of this bidding price for the modeling support to support the bidders doing the financial modeling. So why financial modeling is important? Because this model is the model actually should pass to the lenders or the banks to confirm the financial structure. So that's why the investors or the bidders should try to minimize the risk of a model error. And also, during the modeling exercises, actually, it also helps the bidders to understand the structure, the initial structure of the projects and the key risk of the projects. And the financial models, using the financial models, it is to help investors actually evaluate or assess the profitability of our projects as well as the investment returns of the projects. So there are a few key metrics investors in put in check. So internal rate of return, IRR, which refers to both the equity IRR as well as the dividend IRR of the projects, the IRR, PIRR, of the projects using the discount rate set by the company, the benchmark return rate, cost of the WACC, cost of capital, benchmark cost of capital set by the company. That's will derive an net asset value (NAV), and also the payback period. I believe project has an internal guideline about the minimum IRR targets. Like minimum project IRR, minimum equity IRR, and also the maximum payback periods. A lot of the companies have their internal guidelines, and this actually is built into the calculations of built into the guidelines. All the investors to go through either the investment committee or the management internal decision process before submitting bids. Another part of the financial modeling, financial structuring work is about the sensitivity analysis or the scenario analysis. So for the scenario analysis or sensitivity analysis, the approach is to actually identify the key risk in projects. So later we'll talk about it, but here the type of risk that can be quantified, including cost overrun during construction period, completion delays, O&M cost overrun. These are O&M cost overrun risk, and also output shortfalls, for example, the lower generation or lower productions. So these are the items that can be included into the financial models. And that's why we do sensitivity analysis and scenario analysis. All the risk that can be quantified to help the sponsors to different cases and both the optimistic or upside case, base case, downside or downside cases, for the projects. The level of sensitivity analysis and it's actually depends on also it depends on the structure, the revenue structure, government structure of the projects. So there's no one the modeling and the sensitivity analysis structure in the financial model has to be actually in a way that reflect the commercial and revenue structure of the projects. And we spend every time going through this, which is the risk going to the typical risk. So we talked about the using of financial models to quantify the project risk. The key categories of the project risk are here. This actually is quite a generic, applies to majority of the projects. Construction risk includes the cost overrun, which is the EPC or other non-EPC cost overrun. EPC cost overrun is the major risk. Completion delays, design risk. If the design is the responsibility of the sponsors, and also projects that require interfacing with the projects of other parts is also an interfacing risk as well. This type of construction risk are usually actually they are private parties risk. But then the way of risk communication is actually through the outsourcing or transfer this risk to the contractors. So in the case of a check where if the check is both an EPC contractor as well as an investor, actually there's no risk transfer because the EPC cost stayed with the sponsors as well. But usually for projects where the sponsors, if the sponsors do not play any roles in the construction, they are able to actually transfer the majority of the cost overrun and the delay risk to the EPC contractors, through the EPC contracts. The second is about the financing risk. So the financing risk here, which we talking about the financing risk in the context of the project is able to reach financial close. So which means it is able to reach financial close, but it is still faced with the financing risk of interest rate fluctuations and also the exchange rates fluctuations. So for the bank loans, they are typically based on a floating interest rate that's based on either SOFR is SOFR, and then for Singapore dollars it is SORA. So that is the base rate, and then plus interest margin. The base interest rate actually is a floating rate, so it's fluctuating. Usually, banks would request the lenders to enter into a swap, interest rate swap agreements to hedging the interest risk. However, the hedging period is limited because the typical hedging products can be equal to the US dollar maybe 10 years. And after 10, so it is not a perfect that matches the entire concession period. Then there's also exchange rate risk. This is an issue in countries where the revenue is purely in local currencies, and there's no actually price adjustment that linked to the US dollar exchange rates with US dollars. So there is a currency exposure, currency mismatch, because the financing currencies tend to be US dollar or offshore financing for projects in developing countries. But I think in Malaysia, most of the projects actually finance in ringgit because of very developed liquidity of the ringgit market is very strong. So I think that Malaysia is an exception to this country. In Indonesia, also quite a large part of the projects are financed in Indonesia and the local currencies. And the same for Thailand as well. Thailand, I see most of the projects, the revenues completely in Thai back. So the financing banks are all usually backed by the local banks instead of the offshore lenders. I think for Chad, the case is for a lot of the Chinese companies investing in overseas. Just the financing, majority of financing comes from the Chinese policy banks or big four banks, and which are typically in the US dollar financing. So this is also very the offshore financing is also very common in the countries where there's no very developed banking market and in a lot of countries, the interest rates or the financing cost of local currencies is very high. For example, like in Indonesia, the local currency financing is the cost of the local currency financing is much higher than the US dollar financings. So, and also with the financing risk, there is also a refinancing risk as well. And the project finance loans is typically about 15 years or 20 years. And now in Singapore, I see more and more often the banks actually use a called minimum structure instead of the full amortizer loans. Or minimum type of structure, which means that the tenor of the loans actually much shorter. It can be 5 to 10 years. So after 5 to 10 years, the cash flows from a project is not able to actually fully service the entire loan, fully repay the loan. So there will be a very big chunk, a portion of the loans that actually have to be refinanced at the time of the maturity date of the loan, whether it's 10 years or it's 15 years or it's 20 years, because we said that majority of the concession agreements actually have a life of 20 to 30 years. But the typical bank loans is up to 15 years. For some of the multilateral banks, development bank, AIIB, ADB, IFC, etc., they can extend, they can provide 18 up to 18 years of bank loans. So there's still refinancing needs to cover the financing needs for after the original loan reaches final maturity date. So then the markets, the financial markets, the conditions of the financial market is actually quite unknown. So there is a financing risk, and this is actually also is taken by the private party. So the risk mitigation strategy, including mentioned the interest rate swap, the currency swap instruments that's in place during before the financial close, the risk sharing before the sponsors, which means they are usually multiple shareholders. So the shareholders each will take a portion of the risk. Actually, the risk sharing among the sponsors is actually a very effective way, because sometimes a lot of the risk, the residual risk that are not able to be covered by insurance or transferred to third parties, eventually they have to be taken by the investors. So instead of we rarely see larger transactions, there's only one single investors. So usually they are multiple investors into one project. So this is also a way of risk distribution among the sponsors, and also in the way of having the multiple equity investors. And also, of course, there's a residual risk the banks will typically and for the loan, the finance loans only up to 50 years. So the way they structure it is that actually the cash flow is based on this 15 years of cash flow. But the refinancing risk is more for the equity investors. And then there's also a demand risk. Demand risk is actually only always called the merchant market risk. It applies to projects actually that rely on the users of collector fees, users as the project's revenue, toll roads, and then there's a traffic risk. And there's also significant risk as well. So there's a demand risk. Demand risk is actually it's usually a shared risk because very challenging for private sector to entirely this risk because for a larger infrastructure projects they are factors that are out of the it is a risk not entirely under the control of the private sector because a forecast is only forecast and forecasts are never accurate. And the projects, the demands for projects can change because of the government regulatory changes, because of the competition from other new projects launched by governments, etc. So it's actually very hard to act, and also the private investors are very rightly they wouldn't take all these risks which are out of their control. The government would share the demand risk in the form of providing minimum net revenue guarantee, so that if the revenue level provided for projects, the performance meets the benchmark set by government, the revenue is lower or demand is lower than expected, the government will step in and provide to get the shortfalls so that to ensure the cash flow, the project itself will not breach their financial covenants in the financing agreements. So that this is where the government revenue support will come in. So the government support are in the form of minimum price guarantee or availability payment or get funding type of structure. And then there is also after completion, there's operational risk of the projects, which typically includes the maintenance challenges. And for example, like during the period when if the spare parts or the replacement of components have to be actually imported and they are not available, there's the maintenance challenges, performance shortfalls. Like different PPP projects, there's one annex attached to the PPP document which sets out all the technical performance requirements. Like on the project company, on the sponsors. So there's a performance shortfall which would result in a breach of the agreements and usually could lead to non-termination of the project by the penalties by the government. And also O&M cost overrun. O&M cost overrun is particularly very significant risk in the type of structure that relies on availability payment type of structure. For example, like if the project has a water treatment plants, the O&M cost, the majority of the cost of operations is actually energy or the power cost. So the actual efficiencies is unknown. So every time when the investors actually decide their bidding price, what's the price the government need to pay, they have to actually do the O&M cost estimates, cost projections, which is based on the energy efficiencies. Like for each tons of raw water, how much kilowatts or megawatts hours of electricity needs to be used, and how much was the volume or how many tons of the chemicals have to be used, etc. So the efficiencies is a unknown factor, but they have to be estimated upfront. So I have seen the cases is that the projects actually, after they go into operations, the investors found out that their efficiency assumptions are just too aggressive. And the reason the availability payment is actually calculated based on a formula. So that formula may include a part of the capital cost recovery components and part of the O&M cost pass-through component. The issue is with this O&M operational cost pass-through components because it is a unit cost times the units consumed. So that comes to this operational cost. Usually the government allows inflation index of the unit cost. So it is the inflation is not so much an issue, but the issues actually is with actually the, the units or like electricity consumption is higher than expectations. And that actually results, I think it's one of the main reasons a lot of the water treatment plants, desalinization plants actually not profitable for investors. So this is the operational risk. And then there's also, so for operational risk, only if actually for this type of efficiency ratio, so it's very difficult to pass through the O&M contractors. Unless it is the O&M contractors of the responsibilities to keep the efficiencies. And very often, most of the water generation, the O&M is done in-house rather than outsourced to a third party. So although there is a risk transfer strategy of passing to contractors, but in reality, it's very difficult to mitigate this operational risk if the upfront operational assumptions are just too simply too aggressive. Or in another way, is that it hasn't built into sufficient redundancies of operations costs. The other next series is a force majeure, natural disasters, pandemic, etc. Inside is actually the shared risk. So what it means by sharing, which means that in a force majeure event, when the plant formed or have to stop operations, the investors or the public company will not take full responsibilities. The government will allow a mechanism and period for the company to catch up. And then usually in the PPP agreement, there will be some equitable adjustment mechanisms to allow the investors to increase the price to cover some of the additional costs that's incurred because of the replacement that are not sufficiently to be covered by the insurance proceeds. So that's in this sense, we say force majeure risk is actually shared between private party and government. And the most straightforward way is the insurance, commercial insurance during the construction period versus the commercial insurance during the operation period. So they are comprehensive list of insurance required by the vendors, for this one, we just need actually maybe just remind, like when the bidders, when they are participating in the tender process, they probably don't have a clear idea of how much the insurance costs. So they could be potentially underestimate the insurance cost. So this is important to actually get the details from the insurance policies upfront during the bidding stage. And then the next one is for developing countries, political regulatory risk, including the change of laws, the government breach of contracts, and also instability of the government relations, etc. So these risks that they have to be shared, that actually they are, in most cases, they are the responsibility. So the governments will typically provide us documents, government endorsement of direct agreements, and passing all the regulatory forms for the particular projects. And the government will need to promise about granting the approvals, approval permits, etc. Although the responsibilities of applying for these approvals, licenses, permits lie with the project company. So for the political and regulatory risks, because the government's promise is just a promise. So if it is, if the project is in the developing countries, especially countries like Bangladesh, the lenders would request a political risk of either NICA, other multilateral or financial cover those the currency transfer expropriation risk and also the government official contract risk. The change of law risk is usually in governments and it cannot be covered by the insurance policies. And then the last one is the environmental and social risk. Environmental and social risk are actually not so much about when the project actually reaches project initial cost. It actually means it has completed all the environmental impact and social impact assessment, and also has already created and implemented the ESG risk mitigation plans, etc., that are acceptable to the things. This risk still exists, ESG risk still exists, is that it typically refers to some of the projects that actually affect the local communities or the people, residents' lives or their livelihoods. For example, I think the example would be the Mensong hydropower projects. The hydropower plant projects actually are the projects very prone to ESG risk, which means that it's actually for the project that requires a building of a big reservoirs along the rivers, and that involves relocation of local communities as well. But basically for this type of projects, they are not considered international finances because of the ESG risk. And even if the project has the sponsors for the ESG assessment, and the risk mitigation is actually the impact assessment, use apply the most stringent international IFC standards in setting the impact assessment to decide whether to proceed or not with the project, because this risk actually affects the bankability of the projects. And I think even some projects that have already reached the financial close, later because of the oppositions from the local residents, the local government could stop the projects, and also they have the rights. In some of these community projects, there is usually sometimes there's a call allowing the government to terminate the projects due to the public interest. So usually, I think the example is the Mensong hydropower projects that's constructed by one of the large Chinese power groups in Myanmar, which the construction of the sponsors have already invested billions of dollars. And the project was put on hold by the local government for decades. Next, we come a little bit to the financial modeling. So the financial modeling, we just got the key process. I only want to emphasize the assumptions and inputs. So the assumptions includes the technical assumptions. operational assumptions, cost estimations, revenue projections, and also the in for the financial modeling, actually the cost estimation and the revenue projections are critical, especially if there's a users the demand risk for projects. Cost estimation is the issues with the sponsors, especially in competitive bidding process, is underestimate. That's the issues faced because of the competition. And scenario analysis and also the model and all the steps that as a consultant and then we usually do for investors. The financial model actually need to be submitted as part of the financial assessment, and it has to actually use adopted as the industry standards for project investment, which means the project is acceptable by the project aesthetics. We'll go on to the next. The revenue structure. So we talked about the deep impact of the revenue structure, just run through of the type. There's users fee, which is there's demand risk, availability payment, which is essentially annuity. The reason why actually after COVID, it's becoming increasingly very rare of developing countries to actually use the 100% availability payment type of structure. Because actually the government's budget requires government budget, and using this type of structure, actually the local, unless the private sector has a very strong operational and technical expertise that can bring value to the project. Otherwise, this project is actually more cost efficient, be owned by the government, directly, rather than putting it on the. So I think that over the past 7 years here in Southeast Asia, I've only seen one availability structure. And also shuttle tool. Shuttle tool is actually not so much different from users fee. It applies to actually where all public transport projects, where the revenue is not collected by the private operators, but actually is collected by the government. And then the government, based on the actual usage, the government they will make the payments to the operators on a monthly basis. So it's not like the users fee structure. The common of the structure is the hybrid structure. We work on the projects relies on both the sales of the properties or the users fee as a majority of the source of cash flow or source of income, but also with a minimum guarantees from the government. And in Singapore, the government, Singapore Energy Market Authority started this low carbon electricity program, which is not actually strictly equivalent projects. There is more of a licensing projects, for which the government actually allows for 50% of the agree to undertake up to 50% of the electricity. So for this component, it actually has the government offtake for government support volume. But for the other half, or even more of the electricity outputs, the revenue will be generated from sales under the offtake agreements with the corporate. And some of the recent trends, like overall in the markets, just a quick one is this is projects opportunities projects actually will continue to grow in Southeast Asia as well as in other developing countries because of the as PPP projects, the laws and regulations and procedures become much more standardized. And the critical needs for infrastructure will push the governments in other countries to actually launch more of the PPP projects. So we see more of the PPP activities in developing countries. And in Singapore, these days, there are very few PPP projects that are actually accessible to investors. Technological innovation is one. Technological innovations, I think, this is more of using the digital technologies in all management systems, in all projects, smart meters, smart districts, smart grid projects, etc. So, especially for projects that use so-called design, build, finance, and operate projects, where the part of the technical proposals actually comes from a very heavy weight and overall. The technological innovations or more innovative technology solutions actually will give us actually a great advantage, which I have seen personally that investors coming up with the different alternative energy solutions and which turn out to bring the projects. Another trend is about the legal and regulatory frameworks actually is evolving. We see that it is I think it is not so much about changing the entire procurement procedures of PPPs entirely, but about adjusting, for example, the foreign investors' ownership restrictions, etc. We see some of the countries actually tighten the foreign ownerships of the critical strategic projects. For especially, I think now these days in European countries, it's very difficult for these companies or state-owned companies to actually invest or get access to investing in the strategic projects in those countries. The regulatory, legal, environmentals, and the strategic means in Singapore, the strategic national security review, and actually the laws for restricting foreign investors' access ownership of the critical utilities in Singapore. Sustainability and green PPPs. So these are the greatest field for projects in Southeast Asia. So this covers not only the renewable energy projects, but actually most of the construction projects which use green materials, energy efficient materials, energy efficient, energy saving technologies, waste treatment, etc. So these are still continuing to be the favor of the producers and investors in the market. So I would say that sustainability and the green projects are still actually the priorities for investors who want to have better exit from the projects a few years later. Should focus on sustainability angle or the renewable energy. The next one talk about is the challenges for infrastructure investment. Obviously, is about the high capital commitments. There's a high capital commitments and it requires a capital financing. So even though the needs for infrastructure is great, of course, all developing countries actually very few, only a small portion of the countries are really able to get into the construction stage. And the reason is because the projects not commercially viable, or without sufficient government support or foreign government support. So the high capital requirements is actually the most the biggest hurdle for lots of the infrastructure projects to take place. In the long life cycles, for investors actually the baseline projection is that the projects actually the target return will only be generated at the end of the concession period. So which means actually the return performance of the projects very much relies on the performance of the projects during the operation period, which a lot of unknown at the time of making an investment decisions for the for this long project life risk, one way that I observed from some of the companies in Singapore is they're doing an asset recycle. So after completion of the project a few years, they would actually initiate capitalization either either by listing part of the shares, sponsored shares, transfer part of the sponsored shares to a public listed vehicle, which is usually an infrastructure trust. So in this way, it allows the investors to exit and to recycle the equity capitals they have. But there is a limitation as to how much the capital markets can actually take these risks. They typically will only accept the projects that have a very clear revenue streams, which means probably not and also will only take the projects with a very stable currencies. So a lot of the projects actually in emerging markets and would actually be challenging, actually doing the capital recycling exercise on a project level. It's maybe possible actually for the investors. And then the regulatory and the policy risk is always an issue because of the long cycle. And the government may set higher standards, safety standards, ESG standards, or health standards for the projects, the operational costs. For example, the government could actually change the environmental laws to reduce the emissions by either power plants or the wastewater treatment facilities, which didn't occur in some countries, for example, in China. So it's actually very difficult to pass through this increased cost because of change of law with the water treatment. ESG concerns and also is about the threat of innovative technology. This issue, these challenges is, I think it's very apparent because of the larger scale renewable energy, because of advancement of technology, the equipment costs have become much lower now for renewable energy. So some of the existing projects actually they are even unless they have the undertaking agreements with the governments, they could be facing competitions from the newer projects, newer technology, for example, hydrogen. If it becomes commercially viable, then maybe some of those solar wind projects with battery require battery systems that will become obsolete. So this is the challenges to these are the challenges to infrastructure projects based on my observations. Then I think maybe let's have a 15 minutes break, and then we'll come back to at 11 5 past 11 to finish the the remaining session. Thank you very much.
Is that um they do have some power, but the problem is yeah. Testing. Better. No. No.我不知道 OK 了，肯定 OK。天呐，已经 OK。对对对，所以有点现在调到那个是百分。Is it not and broke and she used to is it better?
PCCC plus and two to that some of the key considerations. Actually, I think in the first section, we already covered a lot about the project finance because for investment and finance of infrastructure projects and PPP projects, the focus on the angle, very much the focus is about help assessing the bankability of the projects. So that's why we already actually run quite several slides. For project finance, as we mentioned, debt finance is very important for infrastructure projects, especially for the greenfield projects. There are three types of debt financing. Actually, only two types of financings: project finance and corporate loans. So project finance, in terms of the level of guarantees from the investors, they are one is called non-recourse project finance, which means the sponsors do not provide any guarantees to the lenders, even during the construction period. So this is the projects that the goals of most of the investors is to actually secure non-recourse financing project finance debt. The sponsor's obligations is only to provide the equity contribution portion of the funding needs. But however, for projects that have a longer construction period, let's say 3 years, 4 years, especially for projects that have a linear structure, like toll roads, railways, etc., the construction risk is so high that we find that the banks or the financiers, they very often request the sponsors to provide a completion guarantee for the construction to cover the construction risk. So in addition to all the other risk mitigation strategies we discussed, so this is the limited recourse finance. Also in countries like in Vietnam, for example, like where the government offtake agreements have some shortfalls, that it doesn't really allow for appropriate risk allocations. The lenders, international lenders, may also request the sponsors to provide limited guarantees for particular events. For example, early termination events, the companies like for if that really occurs. So this is the limited recourse project finance. But in terms of the structure and the key considerations, bankability issues, these two types of finance are actually very much similar. And there's also a corporate loans. Corporate loans are used in, which means the project is actually not structured purely based on the cash flow of the projects, but it's actually relying on the borrowing capacity of the sponsors, or the guarantee, the power, the strength of the guarantees from the sponsors. These corporate loans are sometimes used during the construction phase in projects where there's a very short period of time, which is not enough for lenders to complete the lenders due diligence and to provide the financing before the deadline set by the government. So usually when there's a very tight timeline to reach a financial close, sometimes the sponsors, especially very large conglomerates in the markets, they could use the corporate loans from the sponsors and use it structure it as a shareholder loans to inject into the project company to finance the projects first. And then when the project nears completion, the sponsors will engage the lenders to structure project finance loans to refinance the shareholder loans at a COD. for the key, all the benefits of a project debt, so we just quickly go through. We mentioned about it is first of all, it's purely based on the robustness of the cash flows of the the cash flow projections. The regular it has the the issues that were that will actually affect the commercial viability of the projects is because it's based on the cash flow. So cash flow projections is critical. And secondly is about the contractors' capabilities, which are the EPC contractors and also the O&M contractors experience in similar type of projects. This is to actually to give comfort to the lenders about the contractors are able to actually take the construction risk or operational risk that have been passed to them. And then the tax issues. So the taxes includes both the corporate income tax laws, all the VATs applies to the equipment and materials imported during the construction periods, and also the tax incentives for particularly type of infrastructure projects, and also the tax structuring. Tax structuring refers to especially for the projects that involves foreign investors like a Czech, because of at the end of all the distributions from the projects will actually have to be calculated to the level of the parent company in order for the project team to calculate what's the actual internal rate of return. So which means that all the returns to the Czech parents are after tax. So the withholding tax on the dividends, withholding tax on offshore financing costs have to be taken into account. And this is where the tax structuring take place to minimize or to set up the holding companies in tax havens or tax efficiency locations to allow the projects, the sponsors to minimize the tax costs of the projects. The legal and the regulatory aspect of it. So legal and the regulatory frameworks, contract terms, and also the government support. These are quite important for a lot of the projects in the market. The financing considerations about the availability in the market, availability of financing, access to the capital markets by the sponsors, the risk allocation, so whether it's bankable, and also the market and environmental outlooks also affects the bank's appetite for particular markets. We noted that for example, in some of the emerging markets, because of the changes of the economic environment, the political, the government structure, the investors' appetites may change quite dramatically because of some of the external macro market conditions have changed. The risk allocation and the consortiums. The consortiums affects the bankability or commercial viability of the projects in a way is that because of very often there are multiple shareholders. So whether there's a conflict of interest between the shareholders and whether the alignment of these interests is quite important. For example, if a consortium consists of shareholders who is also EPC contractors, so then these investors may actually want to generate more return or increase a little bit of the EPC price to allow it to hedge part of the operations risk. However, the consortium members who takes up the role as operator of the projects they may want to minimize the EPC cost, but they want to provide sufficient O&M cost assumptions that build it into the project cash flows. So this because of the different roles that and different responsibilities of the consortium members will play in one project, you can sometimes face into situations that the cost estimations becomes a very difficult process because it is the negotiation process between the investors to align their interests. So that's why these consortium members also is important. And of course, in the cross-border transactions where the part of the financing will require the local currency financings, then the local shareholders' financing capabilities is becoming quite critical. For example, in Thailand, if the project actually, majority of the project actually financed by Thai banks in Thailand. So for the company like check, even if like Exim or CDBs can provide a huge facilities, it's not as actually the financing itself actually provided by local banks as well. And also in some of the project, I think, and as well as some of the Chinese companies, there's an issue about the sharing of the risk or guarantee obligations between the shareholders, whether the local shareholders has the capability to take up their responsibilities of the guarantee, even if a non-limited recourse guarantees obligations, which could also become a hurdle for some of the structuring of commercial affecting the bankability of the projects. And then for the benefits of the project finance projects, is cash flow based, it's ring fenced, the structure, so it allows the investors to be their risk exposure to be limited to their equity contribution portions. It's a senior secured, all assets, rights, titles, and accounts are strictly monitored and controlled by the lenders. All the assets of the related to the projects are pledged to the banks. So essentially, for project finance, project investors has no possibility to actually raise additional debt without the consent of the existing lenders, and usually it's very difficult to get any consent for this type of additional debt other than through refinancing after COD. And there's another feature is a longer tenor because it's the debt can be seen as a low cost, the substitute of equity capital at a lower cost because the debt financing cost usually should be lower than the equity returns required by investors. High debt leverage, non-recourse, and also it is a very widely used for all the privately owned projects and PPP projects. Within the project finance, there is one category of the loans called the sustainable linked project finance and green finance loans. They are the same as project finance, but on top of the requirements of the project finance loans, they have the additional certification requirements to ensure that the projects have the sustainability meets the will be used for the projects when have the comprise with the sustainability goals of the set out for the project company, and also it will provide sustainability benefits or green benefits to the society. So for sustainable linked finance and green finance, actually the finance documents are basically the same, except as for typical project finance projects, except that it has the additional KPIs or the ESG KPIs also set into the finance documents, and the project company and the sponsors needs to actually provide additional monitoring and the reporting to the lenders in relation to this ESG targets, KPIs set out in the minutes. Yeah. The project finance, some of the issues with the project finance debt is obviously because it's a highly structured type of financing. So it's a complexity in the execution. Because of the project, the size of the loans is so big. So it typically involves a syndication of banks. So it requires the lenders to actually launch a primary syndication. There's underwriting and syndication process involved. The due diligence process of the lenders is quite long. The due diligence includes both the technical due diligence as well as the financial due diligence, which is the review of the model, certification of the testing, confirmation of the financial model, financial structuring. There's extensive. There are also extensive restrictions and monitoring requirements in these financing documents, which means it's put additional burden on the financial department of the sponsors to actually closely monitoring the financial performance of the project company to make sure the debt service cover ratios of the projects do not fall below the minimum requirements of the lenders. And the third is about the long execution process, which can take 6 months, 9 months, or even longer for most of the projects. And that is why that some of the companies, because the timeline given allowed by the company for allowed by the government for financial close is too short to execute the project finance projects. They would use a bridge loan, corporate bridge loan, to finance the construction of the projects and later arrange a refinancing the way of project finance. At the last, we just cover a little bit about M&A activities. So for infrastructure investments, it comes in two ways. One is by way of participating in tenders for greenfield projects or self-developed projects. Another way is actually through M&A acquisitions of the existing projects or the companies. So Czech actually, as a group, has made acquisitions in the past years in Singapore, and also is also continuously actively looking at the acquisition targets in some of other markets. The types of acquisitions in infrastructure, they're in terms of the targets, the types of targets, I put it in like 4 categories. The first is single asset targets. The single asset targets acquisitions usually involves large scale infrastructure projects. For example, power plant projects with over 1,000 megawatts capacities, single overall one section of the total concessions, which is already $1 billion type of structures, single assets. And the second type is actually a asset portfolio or project portfolios. This means that the acquisitions targets a portfolio of multiple projects. So this type of acquisitions occur quite often for renewable energy projects, because a lot of renewable energy projects in Southeast Asia and in some countries, they typically will have very small installer capacity on standalone basis. And some of the investors or the original investors, they will take the approach is that they develop multiple projects, let's say in Malaysia. They could do some of the multiple develop and invest and build these distributed energy projects for a lot of the industrial parks, the corporations, and etc. But each individually may only have 10 megawatts, 20 megawatts, or even smaller. So it is actually not cost efficient and very hard to actually attract value from an M&A, from a sale of a small single projects. So usually investors will focus on a smaller projects, then they will actually looking to build a very diversified profile of the projects using the same or similar technologies, but in different locations or different countries across the countries. So that's why in renewable energy project, we've seen quite a lot of portfolio transactions. And then for the investors, original investors perspective, the benefit is that as a single project, there's always revenue risk tied to one single project. With one portfolio, there's also a diversification that brings down the project risk, which allows also associated with that is that the investment return requirements for the new investors could be lower. That allows the original investors to actually increase the value, to create a value from a portfolio sale approach rather than sell one single project by project. The other one is the other type of acquisitions I've seen in this region is about acquiring the service capability, the management teams, or the market development abilities. And I believe that CHEP's acquisitions of UESH in Singapore last year actually will fall within these categories because it's the company is an M&E specialist company, so the capacity and the management and the track records they have, the technical qualifications they have, the key are the intangible assets actually are the focus for CHEP, because CHEP is actually looking to leverage the credentials and also the experience of the targets in the water sector and ME sectors for future to participate in the future projects, even though the targets itself they may not actually run any infrastructure projects, but it does have the ongoing contracts, pipeline projects, and also the ongoing contracts, EPC contracts as well, which could generate the revenue to the investors. The fourth one is a type of combination of assets and management team. Again, this is also in some acquisitions for the asset acquisition. Sometimes if the investors who is looking to acquire a target, they have the in-house capabilities. They may actually only acquire the asset code or the assets, and then actually enter into a transitional service agreement with the current shareholders, but they will not take on the management team, meaning they will not actually give additional values to the new projects that the management team will actually bring in. So this is the cases where the investors is in M&A, if the buyer is only interested in the asset, adding the assets rather than expanding their capabilities, they will only look at the asset acquisitions. Majority of the projects are actually a combination of both assets as well as the existing management teams that the buyers will actually rely on the new these acquisition targets to expand into a new markets or diversify into a new businesses. So this applies in the situations where a buyer or investor is interested to expand into a new infrastructure sector or a new geographical market. And this is the set out the M&A, the process of M&A transactions. For M&A transactions, there are two types of process. One type of process is actually the two types of process is determined by the sellers of the of the targets. So the sellers, if they would usually run also a competition auction process to drive out competition among potential buyers for the assets. So they will run a sales process. It could be because of the buyers, investors approaching the shareholders of a target company directly to engage in bilateral direct negotiated transactions. In this case, there's no, the seller usually will not start an auction process, but will engage in direct negotiations with the buyers, and both sides will get into agree on exclusivity periods for these bilateral negotiations. And afterwards, if the negotiation doesn't lead to a binding offer, then the seller and the buyers will walk away. The buyer will walk away, and the sellers who are looking for and look to talk to other investors. So the M&A process involves from the buyer's perspective, usually it starts with the target selection or strategic planning process, and and then goes into execution. And at the end, there's a post-acquisition integration process. So for the first stage, the target selections, this is usually the times when the buyers like a chat, if it's looking interested in one strategic sectors or one market where it doesn't have a presence yet, it will conduct a market study or strategic study to develop acquisition plans and to justify whether an acquisition or internal growth of the capacity, which one is the most cost efficient and most effective way. If acquisition is the most effective way, then it will actually engage a consultant to start with the selection. So first of all is to set the target selection criteria, including the target's technical capabilities, their business size, the size of the business, the revenues, the financial positions, the legal standings, the shareholder structure, etc. All these comes into considerations. Acquisition of publicly listed companies obviously is much more complex and involves reporting and announcements, a lot of the filing requirements by the stock exchange, securities commissions. So majority of the acquisitions that done by the strategic investors are actually acquisitions of non-public companies, which doesn't have this very stringent filing requirements by the stock commissions. And then there was a screening shortlisting, and typically the buyer would reach out to the sellers to engage in or soft market sounding and express our interest on the target. If the seller is interested in discussing with the buyers to bring it forward, both sides will sign MOU or NDA to during this process. And then once the NDA, non-disclosure agreements or a confidentiality agreement, once this is signed, the project is formally kick off for the execution. The execution, usually for larger size infrastructure projects, it will involve typically 3 stage or 4 stage. The first 2 stages, the offering stage and the due diligence stage. The due diligence can be put into the phase 1 is a limited scope due diligence, or so-called preliminary due diligence, which usually involves a financial, legal, tax, and sometimes there's commercial due diligence as well. So this is actually the high-level due diligence, allowing the investors the buyers to actually find if there are any material risk about this company, which can actually which are deal breaker. So if they find any deal breaker through the phase one limited scope due diligence, they will stop the process. But if there's no, actually after the initial due diligence, they feel comfortable about identify the risk, buyers then will present a non-binding offer letter to the sellers. So the non-binding offer letter obviously is non-binding. So it will be set out that the price, the indicative price is subject to satisfactory due diligence and the next phase, and subject to a satisfactory documentations, etc., etc. Then the both sides will go to the binding offer submissions. So the binding offer submissions, before the submissions, for the companies that check, and they need to, and actually for all companies, they need to complete all the due diligence requirements on the targets. So which also include the technical due diligence, and potentially some of the human resources or technology due diligence as well. After completion, like in this stage, a very big part is about the valuation. So the purchase price, the offer submitted by buyers, that it comes from the valuation exercise. So the valuation exercise involves a financial modeling, and all as well as other approach. Typically for the investment banks and also for consultants would use an income approach, which is the discounted cash flow calculations to decide on NPV, net present value of targets, and also the market approach, which is applying the trading multiples of similar public listed companies in similar sector or in similar transactions to the same company. So this is the market approach. So from non-binding offer submission to binding offer submission, in the non-binding offer letter, the buyer will actually set out all the major assumptions and conditions of its price of its offer. And then during the due diligence, the phase two stage, with the new findings from the full due diligence, it will adjust all the assumptions in the financial model. And then, which means the price can be different. That's why in the phase two, the financial model will be updated, and all of the price and sensitivity analysis will be adjusted and to be reflected into the finding offer. But in reality, a buyer should try not to reduce the price. The expectation is always like in phase two, the price would be slightly higher than the non-binding offer price. So because if the binding offer price is actually lower than the non-binding offer price, actually it brings a very bad feelings to the sellers, which actually could affect the chemistries between the buyer and sellers in the going forward. So the expectation is either the price will keep the same, or they actually should be a slight improvement after the full due diligence. So after the full due diligence is also the stage where the buyers is able to actually develop their complete their risk analysis and risk assessment. They will only get into a transactions if they believe the risks are manageable at this stage. So, and at the same time as the submission, there's also internal approval processes about the management approval, board approval from the parent companies. This applies to check, and also other state-owned companies as well. That all these approval process typically starts from the binding offer phase. So the binding offer has to be fully approved by the management, by the board. But then the non-binding offer letter can be a letter actually drafted by the project teams, supported by the local management. And then if the binding offer letter is accepted by the seller and the target's management, both sides will enter into a negotiation phase of a new exclusivity phase, which is for the drafting of the M&A transaction documents and also the negotiations of the terms and conditions. At this time, also for companies like check that again there will be transaction structuring, which is to decide the holding structures to ensure to bring the most tax efficient transaction structure. So this is and after the term sheets agreed, and then both sides will get into the drafting of the formal full share purchase agreement, which is SPA. So SPA itself is not so much it's not a very large document. Actually, it's much more. It's 20 pages or 30 pages. So compared to the project documents for PPP projects or project finance documents, SPA M&A transaction documents is actually document itself is very simple. If the acquisition is a partial acquisitions and the sellers remain as a minority shareholders. So the buyer and seller and the existing shareholders need to also drafting the shareholder agreements, because the new company will become a joint venture with not more than one shareholders at a time. And also some of the company bylaws, like articles of associations, etc. Some of them, the board meetings requirements, those have to be amended based on the requirements of the buyers. And then when the terms are agreed, actually the most intensive part is the binding offer submission and transaction documents negotiation phase are actually the critical and the phase of M&A transactions. After documents are agreed for the signing, and actually typically M&A transactions are not closed at the time of signing, because in the M&A documents will include a list of conditions that both sides have to meet before the payments of the purchase price and the transfer of the shares. So these conditions would include some of the regulatory approvals, including the antitrust laws, if the combined market shares of the companies of the transactions were actually reach a point of that it requires antitrust review by the local by the government in both the buyer's jurisdiction as well as in the target's jurisdiction as well. And also if it's a very large transactions, acquisition finance may be involved as well. So the buyers need to talk to banks and to arrange debt financing to finance part of, in a similar way as a project finance. Like they need a loan to finance the acquisitions, and this will start actually during the binding offer phase and then reach the financial close before at the same time as the closing of the acquisition transactions. So the acquisition transactions, the documents itself will include both when I said that the documents are actually relatively simple documents, it's because it mainly covers the seller's representations and the warranties. So the representations are actually based on, which means are based on the information, the data room provided by the seller for the buyer's due diligence. And then the buyers will request the sellers to represent that the information provided to them are correct, accurate, and there's no misleading or misrepresentation. So that's why to put these responsibilities for the accuracy of information back to the sellers, because this is based on the information the buyer offer the purchase price. And there's also some warranties. Warranties means they are also is given by the seller and is requested by buyers. It typically includes tax warranties. So typically in the due diligence process, because the due diligence is for the buyers, they will only conduct for financial and tax, they will only conduct the due diligence for the past 2 to 3 years. But then for the tax authorities, if the tax authorities in the target company, they can actually backtrack and request a review of entities' tax filings back to 5 years. So, which means there's a gap between the due diligence scope and the potential tax liabilities that are still staying within the companies that haven't been identified or wasn't included in the due diligence scope. So in order to cover this gap of due diligence and what actually happened between the companies, the buyers would also ask the sellers to provide additional warranties. So if the sellers are found to if the targets after acquisitions, it was fined by tax authorities, requested to pay additional taxes, which involves additional tax payments, etc. Then the buyers has right to actually request the sellers to compensate for this additional cost or penalties and regulators, etc. So it's usually the warranties used to cover potential regulatory obligations and penalties by the regulators. That's here. So that is what the SPA basically means. Once the SPA, once the purchase price conditions have been satisfied, the purchase price are met, the shares are transferred at the same time, and the share transfer registration should be completed almost at the same time or just on a different day. So this is the transaction, the execution process for execution process for acquisition transactions. And then after completion of the transaction, there is still quite a lot to do. Is about the post-acquisition integrations. So typically, this will include both appointments of a new management by the new controlling shareholders to the target companies, the change of the board members with the new members to be appointed to the board, and the developing integration plans, also alignment of the management system, financial reporting system, procurement systems, quality control, safety, or other governance systems of the packets and also the with the buyers and the investors. So M&A is actually a way because for the bidding compared to the tender participation in a tender of a greenfield project, M&A is actually sometimes is more it's more efficient way to expand the assets or enter into a new market, because the public tenders, it can actually take quite a long time to the launch, and also the competition for the projects can be very the opportunity or the chance to win publicly tendered projects is not as high. So we see most of the private, especially for private equity firms, focus on infrastructure investments. They don't actually participate in the tenders that much. Sometimes they participate as a minority consortium members, but they will put their focus on M&A transactions. And also the same, I think, for some of the engineering and the construction companies, M&A is a way for some of the international Japanese counterparties to check. They will make acquisitions in Vietnam, in these countries, and same for Czech as well. Acquisition is one of the investment strategy of the group. So that's why we cover this the very last. Okay. So with this, just want to thank you. Thank you all for your attention this morning. So, just wondering if you have any questions, issues you want to discuss, or if I have missed anything that you think